Delighted to have you in this revision lesson for management accounting. As your instructor, my role today is to guide you clearly and systematically through the CPA exam-style questions in Chapter 3 on cost estimation. Since this is a revision session, we will go straight to the questions and focus on understanding how to approach and answer them confidently in the exam, beginning with question 3.1.1. The discussion follows the worked examples provided in the attached material. Question 3.1.1. Accounts analysis method begins by testing your understanding of cost behavior based on the nature of costs. In this question, you are given a list of costs incurred by a manufacturing company over the past year, namely utilities, raw materials, salaries, maintenance costs, and rent. The accounts analysis method relies on managerial judgment and knowledge of operations to classify each cost as either fixed or variable. This method is commonly examined because it reflects real-world decision-making, where accountants must interpret cost information rather than rely purely on formulas. When applying this method, the first step is to identify fixed costs. Fixed costs are those that remain constant within a relevant range of activity, regardless of the level of production. In the given data, salaries amounting to $120,000 are treated as fixed because staff salaries are usually paid at agreed rates and do not fluctuate directly with short-term changes in output. Similarly, rent of $24,000 is a fixed cost because it is paid for the use of premises and remains the same whether the factory produces many units or very few. In an exam, it is important not just to list these items as fixed, but also to clearly state the reason why they do not vary with production levels. The next step is to identify variable costs, which change in total in direct proportion to changes in activity. Raw materials costing $50,000 are a classic example of a variable cost because the more units produced, the more raw materials are consumed. Utilities of $10,000 are also classified as variable in this context because electricity, water, and fuel usage typically increase as production activity increases. Maintenance costs of $15,000 are treated as variable as well, since higher machine usage usually leads to more frequent servicing and repairs. Although in practice maintenance may sometimes have fixed elements, for exam purposes you should follow the logic provided and justify it based on increased usage of equipment. The justification section of this question is particularly important for CPA students. Examiners want to see that you understand the principle that fixed costs remain unchanged in total within the relevant range, while variable costs fluctuate with the level of activity. A clear explanation shows that you are not merely memorizing definitions but can apply them to practical business situations. You should always link your justification to production levels or activity drivers. From a management accounting perspective, the accounts analysis method is useful because it is simple and quick to apply, especially when historical data is limited. However, you should also remember its limitation. It is subjective and depends heavily on the accountant's judgment. In revision, always be prepared to comment briefly on why a method is appropriate and what its weaknesses might be, even if the question does not explicitly ask for limitations. In summary, question 3.1.1 tests your ability to classify costs correctly and justify your reasoning using basic cost behavior concepts. A well-structured answer clearly separates fixed and variable costs, provides sound explanations, and demonstrates an understanding of how managers use such classifications for planning, control, and decision-making. This approach sets a strong foundation for tackling the subsequent questions on quantitative cost estimation methods in this chapter. We now proceed to question 3.1.2, high-low method, which examines your ability to separate mixed costs into their fixed and variable components using historical activity data. This question is very common in CPA examinations because it tests both computational accuracy and conceptual understanding of cost behavior. As illustrated in the attached material in this question, the company provides production and total cost data for 3 different months, with output levels of 1,000 units at a cost of $15,000, 2,000 units at a cost of $25,000, and 3,000 units at a cost of $30,000. The high-low method requires you to focus only on the highest and lowest activity levels, ignoring the middle observation. This is important to remember in the exam, because students often make the mistake of averaging all data points, which is not how this method works. The first step is to identify the highest and lowest activity levels. The highest activity level is 3,000 units with a total cost of $30,000, while the lowest activity level is 1,000 units with a total cost of $15,000. These 2 points are used because they represent the widest range of activity and are assumed to best capture cost behavior within the relevant range. The second step is to calculate the variable cost per unit. This is done by taking the change in total cost and dividing it by the change in activity level. The difference in cost between the high and low points is $30,000 minus $15,000, which equals $15,000. The difference in activity is 3,000 units minus 1,000 units, which equals 2,000 units. Dividing $15,000 by 2,000 units gives a variable cost per unit of $7.50. In an exam setting, it is essential to show this calculation clearly, as marks are often awarded for method as well as the final answer. The third step is to calculate the fixed cost. This is done by substituting the variable cost per unit back into the total cost equation using either the high point or the low point. Using the high point, the total cost of $30,000 is equal to fixed cost plus $7.50 multiplied by 3,000 units. The variable portion is therefore $22,500, and when this is deducted from the total cost, the fixed cost is calculated as $7,500. You could also arrive at the same fixed cost using the low point, which acts as a useful check in revision. The significance of these results is critical from a management accounting perspective. By separating total cost into fixed and variable components, management can estimate total costs at different levels of production, prepare more accurate budgets, and make informed pricing and output decisions. For example, knowing that each additional unit costs $7.50 to produce helps management assess contribution margins and profitability. Similarly, understanding that fixed costs are $7,500 helps in break-even analysis and capacity planning. However, as part of your revision, you should also remember the limitations of the high-low method. It relies on only 2 data points and assumes a linear cost relationship, which may oversimplify real-world cost behavior. Despite this limitation, it remains popular in exams because it is easy to apply and demonstrates the basic principles of cost estimation. Having revised the high-low method, we are now well positioned to move into question 3.2, which introduces mathematical methods of cost estimation, beginning with the scatter graph method. We now proceed to question 3.2.1, scatter graph method, which introduces a visual and analytical approach to understanding cost behavior using historical data. This question is designed to test your ability to interpret cost patterns rather than perform complex calculations, and it is particularly useful in revision because it strengthens your intuition about how costs respond to changes in activity levels. As shown in the attached material in this question, you are given production levels of 100, 200, 300, 400, and 500 units, with corresponding total costs of $1,200, $1,500, $1,800, $2,600, and $2,000 respectively. The first requirement is to plot this information on a scatter graph, placing production level on the horizontal axis and total cost on the vertical axis. Each pair of figures is plotted as a point on the graph. Although the exam may not always require you to physically draw the graph, you must clearly explain what the plotted points would show. Once the points are plotted, the next step is to observe the pattern formed by the data. From 100 to 300 units, total cost increases in a fairly consistent manner as production increases. This indicates a positive relationship between activity level and cost, which is typical of costs that have a variable component. In revision, it is important to explicitly state this relationship, as examiners reward clear interpretation of trend. However, the data also shows irregularities. At 400 units, the total cost rises sharply to $2,600, which is significantly higher than what would be expected based on the earlier trend. At 500 units, the total cost drops to $2,000, which is lower than the expected continuation of the trend. These observations are known as outliers. In an exam answer, you should explain that such outliers may be caused by abnormal events such as major repairs, temporary inefficiencies, bulk purchase discounts, or short-term cost-saving measures. Recognizing and explaining outliers demonstrates strong analytical skills. Despite these irregular points, the overall pattern of the scatter graph suggests a mixed cost behavior. This means that Total cost is made up of a fixed element, which is incurred even at low levels of production, and a variable element, which increases as production increases. This conclusion is very important because many exam questions test whether students can distinguish between pure variable costs and mixed costs based on visual evidence. The final part of the question asks how the scatter diagram can be used for future cost estimation. Management would draw a line of best fit through the majority of the points, deliberately ignoring abnormal observations where appropriate. The slope of this line represents the estimated variable cost per unit, while the point where the line intercepts the vertical axis represents the estimated fixed cost. This estimated cost function can then be used to prepare budgets, forecast costs at different levels of production, support pricing and production decisions, and identify abnormal cost behavior that may require further investigation. From a revision standpoint, you should remember that the scatter graph method is simple and visually intuitive, but it also has limitations. It involves judgment in drawing the line of best fit and does not provide precise numerical estimates compared to regression analysis. Nevertheless, it is very useful as a preliminary analysis tool and is often used to identify whether more advanced methods, such as regression, are appropriate. With this understanding of the scatter graph method, we are now ready to proceed to question 3.2.2, Ordinary Least Squares Method, Simple Regression Only, which provides a more precise mathematical approach to cost and revenue estimation. We now proceed to question 3.2.2, Ordinary Least Squares Method, Simple Regression Only, which is the most quantitative and analytically demanding question in this revision lesson. This question is very important for CPA students because it links management accounting to basic statistical analysis and shows how managers can use data to make more accurate predictions. The discussion that follows is based on the worked example in the attached material. In this question, the company has collected data on monthly advertising expenditure and the corresponding sales revenue for 6 months. Advertising expenditure is treated as the independent variable, while sales revenue is the dependent variable. The objective of the ordinary least squares, or OLS, method is to find a straight line equation that best describes the relationship between these two variables. This line is known as the regression line and is expressed in the form sales revenue equals A plus BX, where A represents the intercept and B represents the slope. The first step in applying the OLS method is to compute the necessary summary statistics from the data. These include the number of observations, the total of the advertising expenditure values, the total of the sales revenue values, the sum of the products of advertising expenditure and sales revenue, and the sum of the squares of the advertising expenditure values. In this question, there are 6 observations. The total advertising expenditure is $19,500, while the total sales revenue is $158,000. The sum of the products of X and Y is $424,500,000, and the sum of the squares of X is $67,750,000. In the exam, accuracy at this stage is critical, as any error will affect all subsequent calculations. The second step is to calculate the slope of the regression line, denoted by B. The slope measures the change in sales revenue for a 1-unit change in advertising expenditure. Using the OLS formula, the slope is calculated by taking the difference between n multiplied by the sum of xy and the product of the sum of x and the sum of y, divided by the difference between n multiplied by the sum of x squared and the square of the sum of x. Applying the values given results in a slope of approximately 96.83. This means that, on average, every additional dollar spent on advertising is associated with an increase in sales revenue of about $96.83. The third step is to calculate the intercept, denoted by A. The intercept represents the estimated value of sales revenue when advertising expenditure is 0. Using the formula provided, the intercept is calculated as approximately negative $287,864.17. Although this figure is negative and not practically realistic, it is mathematically valid within the regression model. In revision, it is important to remember that intercepts in management accounting regressions may not always have a direct real-world interpretation, especially when 0 activity levels are outside the relevant range. The regression equation can now be stated as sales revenue equals negative $287,864.17 plus 96.83 multiplied by advertising expenditure. This Equation summarizes the estimated linear relationship between advertising spend and sales revenue and forms the basis for interpretation and prediction. Interpreting the results is a key requirement of this question. The slope indicates a strong positive relationship between advertising expenditure and sales revenue, suggesting that increased advertising is likely to drive higher sales. The intercept, while negative, simply reflects the position of the regression line and should be interpreted with caution. In CPA exams, clear interpretation often earns as many marks as the calculations themselves. The final part of the question requires prediction. To estimate sales revenue when advertising expenditure is $5,000, this value is substituted into the regression equation. Doing so gives a predicted sales revenue of approximately $196,285.83. This demonstrates how regression analysis can be used by management for forecasting and planning purposes. From a management accounting perspective, the ordinary least squares method is more accurate and objective than methods such as the high-low or scatter graph methods because it uses all available data points and minimizes the overall error in estimation. However, it also assumes a linear relationship and requires reliable data. In revision, you should be able to explain not only how to perform the calculations, but also why management would prefer this method when accurate forecasting is critical. This completes our revision of Chapter 3 worked questions on cost estimation.